Hey guys, Tom here from the Investing with Tom YouTube channel. Welcome back to the channel. If you enjoyed today's video, hit like, hit subscribe, and that way you can see future videos as well. So one of my favorite investors of all time, and a favorite of many of you as well, I'm sure, is a guy by the name of Mohnish Pabrai. And Mohnish Pabrai recently sat down with SumZero to do an article on his thoughts on everything that's sort of happening in the global financial markets at the moment. We've had some very volatile times with stocks, as many of you will know. So I want to get into Mohnish's opinions on what he thinks the long-term impact of what's happening out there at the moment is going to be, and how he thinks you should be kind of contemplating your investments and thinking through things at the moment. So have to give a quick shout out to Brad Kellner, the stock compounder. I hope I'm not butchering your surname there, Brad. But Brad pointed me in the direction of this article just this morning. So go check out his YouTube channel as well. I will leave a link for that in the description below somewhere. So without further ado, let's get into the video. So for those who don't know about Mohnish Pabrai's investing strategy, as a bit of background to this, essentially he's a big-time Warren Buffett, Charlie Munger sort of disciple, definitely goes in the value investor camp and is really trying to find deeply undervalued businesses. I would classify him more as an older school Warren Buffett type investor. He's not quite transitioned into the great business at a fair price. He's still really looking for those deeply undervalued businesses because he's still working with, although it's right around $1 billion, much smaller amounts of capital than the likes of Berkshire Hathaway are working with. So his long-term track record is phenomenal. And that's the kind of investing strategy he uses. So in terms of how he determines intrinsic value when he's looking at a business, it's basically the exact method that I went through about a month ago in my intrinsic value update video. That method literally came straight from Pabrai's book, The Dundo Investor. And although that's sort of the framework and the way that he thinks through things, often he's looking for such big discounts that he shouldn't need an Excel spreadsheet to figure out whether it's cheap or not. So that's Mohnish Pabrai's background, and with all of that said, just so you've got a bit of context on kind of some of the answers that Pabrai gives to some of the questions he was asked by SumZero, that's a bit of background. So let's get right into it. So the first question asked to Mr. Mohnish Pabrai was, many public market investors have notoriously short-term time horizons. Do you think investors have sufficiently discounted 2020 earnings and truly shifted their focus to 2021? And this first question and first answer kind of gets to the core of this entire article, where Mohnish Pabrai says that an investor with a short-term horizon is typically not an investor. Mostly those are speculators. When I invest in a business, I really focus on 2020 or 2021 or 2022 earnings. The value of any business is the sum of the cash that can be distributed to its owners over the lifetime of the business, discounted at a reasonable interest rate. 2020 and 2021 earnings are irrelevant. Now this answer is amazing. If you don't quite understand what Pabrai was saying there, I'd recommend having a look at my previous discounted cash flow video to get a feel for kind of the framework that he's using when he's talking about these answers. But the example I've heard Pabrai use before is the example of trying to put a value on a company like Amazon. So the first thing you need to realize when you value a business is the present value of all of the future cash that that business will produce is the intrinsic value. So you basically need to figure out how much cash Amazon in this case will earn over its entire lifetime. You need to figure out what kind of rate of return you want to make. That's your discount rate. And then you need to work backwards, discount all those years of cash flow, and then add that all together, and that's about what you should be paying for the business. So the first thing you're going to have to do is figure out, okay, when does Amazon go bankrupt? Is it going to be in 2030, 2040, 2050? 2100? Eventually pretty much all businesses go to zero, and Amazon probably will at some point as well. So that's the first thing you need to figure out, and then you need to figure out what the cash flows are going to be for that entire period. So between now and say 2100, what is going to be the cash flow of Amazon every single year? And what return do we want to make? So obviously there's some big questions that probably not even Jeff Bezos can answer in there. And so we get to this this situation where determining the intrinsic value of a business is near on impossible to do accurately. Or I shouldn't say accurately, to do precisely. So you can't really look at these things to two decimal places. And it's one of the reasons why Pabrai tends to just eliminate a business altogether if he can't do the maths just in his head to figure out whether it's cheap or not. So that is what Pabrai is talking about here. We need to focus on the long term. And if you're going to look out to 100 years into the future for that entire lifetime of Amazon, 1 or 2 years of poor earnings doesn't matter. So there are some comments on the current illness floating around the world that Pabrai makes, which I don't want to go into too much detail on that here. One, because I might get demonetized, and two, because I don't think it's super relevant to actually practically trying to help you become a better investor. So we're going to skip through some of those and get to the actual business fundamentals of what is going on at the moment. So the next question is, which industries may be permanently affected? And Pabrai says to this, most businesses by their nature are very fragile. A lot of mom and pop restaurants will unfortunately go bankrupt. Many small businesses will not make it. The government backstop is massive, but it's very hard to do this at scale and avoid widespread fraud. A lot of retailers won't make it. In general, leveraged businesses are going to have a very hard time. So that's companies with a large amount of debt. I deeply admire what the Fed and Congress has done and are trying to do. They understand the situation well, but policies without unintended negative consequences are hard to execute when one is moving so fast. So if there's any takeaway from that particular question, it's businesses with a lot of leverage, businesses with a lot of debt, and particularly businesses that skate on thin margins. So something like an auto company, they can go from being very profitable to not very profitable quite quickly. And if they're not very profitable or they're losing money and they also have a lot of debt, that can be a very, very bad situation. That's essentially what Pabrai is trying to tell us here. Next question I want to get into is, do you foresee a shift back to value investing from passive investing as a result of pandemic-related market volatility? And relatively short answer to this, value investing is always a small minority pursuit. Very few humans can resist following the herd. And basically what that means is, when you're a value investor and you're buying into a company, almost by definition, you are buying into a company that the rest of the investors in the stock market absolutely hate at that point in time for whatever reason. If they didn't hate it and if they weren't selling all their shares at mass scale, it wouldn't be at a huge discount to intrinsic value, at least not very often. And because of that, you need to be able to stray from the herd, as it were, and make investments in companies where you're confident in the future of the business and you're confident you've got a good margin of safety, and you're confident that over the long term this is going to do really, really well. And it's simply just been beat up by a lot of short-term speculators, as Pabrai would call them, and people that don't have longer-term time horizons. So that largely is what value investing is all about. As I think Ben Graham put it, you're not right because people think you're right. You're not right in investment because people agree with you or disagree with you. You are right or wrong because your facts and your reasoning are either correct or incorrect. That's what investing is all about. So the next main question I want to cover is, SumZero basically asked Pabrai for a stock tip, which you should never do, and please don't ever ask me for them because you know that I will not answer that question. But they basically said, what are your 3 favorite stocks currently as long-term buys? And his answer was, I'll duck this question. And then so SumZero rephrased and they said, so without specifically saying which are your favorites and any stocks in particular, what are any stocks that you think of as long-term compounders or value plays, which you think warrant close re-examination due to the current situation in the world? In other words, do any great businesses come to mind which you think long-term investors could buy at a significant discount to intrinsic value, which is the core of what we're trying to do here? And Pabrai bought up 2 stocks. So he bought up one called Carriage Services and one called Live Nation. And he says, I've never owned either one. Carriage Services is a funeral services business in the age of what is currently going on in the world, there's no chance that their business is in decline. In fact, the doom and gloom crowd should have piled into carriage services if they expected millions or more to die. From its December peak, however, carriage is down 45%, which obviously makes no sense. And then we have Live Nation. They own Ticketmaster, and what's currently going on, enabled a concert to take place somewhere in the world every 15 minutes. Those 3,500 plus global concerts are now down to 0, and they're likely to stay at 0 for quite a while. From its recent February peak, Live Nation has been cut in half, exactly the same as the first business, Carriage Services, which is very, very stable and even a growing business right now. So Live Nation has been cut in half. I'm curiously waiting for Live Nation to release its Q2 numbers in July. Their revenues may approximate 0. Quite different from the numbers Carriage Services is likely to report in Q2. Carriage Services will be quite profitable in Q2. How much sense do the valuations of these two businesses make today and 3 months ago? You've got one business that's doing perfectly fine, probably even better than they were in the past. One business that is suffering horrendously, and they are both down the same amount compared to where they were a few months ago. So great example of highly inefficient pricing in the market, and potential places where you can take advantage. Again, they're not stock tips, but just a demonstration of how crazy and I guess illogical stocks can be priced, just because of wider market forces, rather than focusing on the actual underlying business, which is what really drives long-term returns. In Pabrai finishes this with, I love Live Nation as a business, and I believe humans will be back to attending sold-out Taylor Swift concerts in close contact with each other in 2021. But even after a 50% drop, Live Nation is not cheap enough for an Excel-phobic guy like me. I still can't do the math on it on one hand. Maybe after a few reports of 0 revenue quarters, I will finally be able to buy it. If there's a long-term compounder, it's Live Nation. So those are some thoughts. Those definitely aren't all the questions in this interview, but that's a bit of a taste of the way that Pabrai is currently thinking through some of the things that are going on at the moment. And they basically asked him to finish the interview, any final thoughts, and Pabrai said, "This too shall pass. Humanity dodged this bullet very well, and will make sure there are no future pandemics that create the mayhem this one did." So interpret that as you wish. I, for one, am pretty much already on board with all the stuff that Pabrai has said. I think that over the long term, if you're going to own a business for a very, very long time, 1 or 2 years don't really matter that much in terms of earnings. So if there are dramatic falls in prices, and they're not falling from levels of extremely high valuations already, if they're getting to a discount to intrinsic value, there's potentially some very good investment opportunities coming up right now, and that's the way we've got to think about it. So hope you enjoyed the video. Definitely check out the full interview. I highly recommend it, and thank you to Brad for directing me to this one. So that is all from me today. Hope you enjoyed the video. If you did, hit like, hit subscribe, and I'll see you in the next one. Cheers.